Hello and welcome to the Trading Zone. I'm Joe Teague, and with me is Brian Stutland. How's it going, Brian?
Great. How you doing, Joe?
Doing great. Had a great weekend. Just feels like the dog days of summers are on us. Usually we have a lull in trading in the dog days of summer, but that's not happening this year.
No, not at all. It's been quite a ride actually the last couple of weeks. The market kind of topped out in the middle of July, and just in less than 10 trading days, we've seen an extreme fall in the markets, a rise in volatility. So, and obviously a big week coming up here with lots of things on tap between earnings, Fed decisions, and whatnot. Joe, one thing that was interesting to me, which is maybe one of the key stories, is this Kobayashi letter on Twitter, or X, I should call it, highlighting the unemployment rate and how highly correlated that is to leading towards recessions. Joe, you and I have been talking about it for weeks. Maybe they were listening into what we had to say.
Yeah, that's what we've been saying all year long, Brian. That's been kind of the theme. We'll get into it as the show goes on. Maybe we'll give people just a second to join in as we're just getting started here. Thanks, everybody, again, for joining with us. It means a lot that you're here. Remember, we're here to answer any questions that you have. Feel free to shoot them in and feel free to recommend this to your friends out there who might be interested in portfolio management and volatility. Remember, that's what Brian and I do. We're former options market makers, wealth of knowledge when it comes to options trading, a specialty when it comes to volatility, and unique understanding of the VIX. Brian, you were an early adapter of VIX trading, one of the first traders in that pit. So there are just a handful of people in the world, I mean, not to be hyperbolic here, that knows the VIX better than you do.
Yeah, well, that's where we cut our teeth, and we want to express some of those ideas in the form of risk management for people. Trading in those pits, obviously, it was taking the opposite side of those trying to manage their risk, and then also lay off my risk as well. So we know a lot about volatility in the marketplace, and here on the Trading Zone, we cover lots. We cover a big story on the week, which we'll get into, and along with some of the volatility zone section of where we think ripple effects can be occurring in the market. And then we have a great trade later on in the show, right, Joe?
Yeah, that's right. That's absolutely true. Let's get into it all, just like we were talking about. It's something we've been bringing up all year long. The markets has been climbing this wall of worry. People are saying, the economy is slowing down. These high rates are crippling investors. Everything is coming to a screeching halt. The Fed needs to cut rates. All year long, Brian, what have we been saying? Usually the market climbs this wall of worries. It's usually expansionary when the Fed is tightening in a tightening policy. The time to worry is when the Fed starts loosening. You got to be cautious when the Fed lowers rates. That's typically when the economy slows down. It's like people forgot about that all year long. It's like, it seems so wise and intuitive, but it seems hard to do in the moment. Now we're at a point, yes, the economy might be slowing down. The Fed's looking to cut rates, Brian.
Yeah, and the Fed decision coming up here on Wednesday is obviously
a crucial factor here. Brian, I think you're freezing up just a little
heavy
bit.
indication that cuts are coming.
Yes, cuts are coming, Brian. Sorry, you're just freezing up just a little bit. Yes. So according to this Kobayashi letter, a recession will be here if the Friday jobs report has unemployment above 4.2%. We're kind of trending in that direction. I'm not certain that will happen, but there's certainly evidence and sign that the economy is slowing down, and there's a lot of angst out there, especially in the mega cap sector, in the growth sector of the economy, the semiconductor, the AI trade, which has been such a big winner year to date. Lion's share of the gains to start the year came from the mega cap, came from the semiconductors, came from the Magnificent Seven. And that really unwound in a big way in July, Brian.
Yeah, it did. And that's really going to be our big story of the week. We're going to get more into this later on in the show, but we want to talk about some of the Mag 7, what it means for the market. Can the market continue to move higher without them? The rotation obviously has been huge in the news. Lots of people talking about the small cap rotation that's been occurring. Large cap value also up, I believe, like 3.5% or so month to date. So that section of the market where people are looking for the value, for banks, for smaller names, other parts that hadn't participated in the rally, have sort of seen this huge rotation. But we want to get into the analysis of where the entire broad market can go in general with this Mag 7, and obviously Microsoft earnings this week, tomorrow after the close. We got to get into that.
Yeah, Amazon coming up, Apple also coming up. I mentioned the jobs report Friday and the Fed decision Wednesday. This is a crucial week, Brian, and we'll get into exactly why. There it is right there again. What a huge week. And this is really coming right at a crucial level technically for the market. But real quick, this is what we brought up last week, Brian. And I bring this up on the extremes because it's a very good contrarian indicator on the extremes. Just another reason why to catch us every week if you don't, because it was showing extreme greed here in this indicator. The week ending before last, everybody was piling in bullish to the market, and we really had a rough week. A lot of people falling on their face here. So when I see this indicator on an extreme, it's a very good contrarian indicator for me. Just look at the the low of the market here, the week ending, the week's beginning in November here. That was a great time to be buying the market. Last week, basically a 52-week high here. Not a good time to be buying the market. So very good contrarian indicator for me, just to be cautious when these markets are on these extremes.
Yeah, and obviously we get that into let's maybe just step it into the volatility zone on space and where volatility is, because these are also very good contrarian indicators, or maybe even momentum players. Here, when we look at the skew index, this is relative implied volatilities of puts, demand for puts on the downside in the S&P 500 versus the demand for calls on the S&P 500. Calls obviously are a play to the upside. Puts are typically used to protect portfolios or echo a short position in the market. And when we see these demands start to increase for puts, that can be somewhat of an indicator of sort of a panic into the market. But sometimes it gets ahead of the market after reaching all-time highs. We are starting to see this skew index now maybe looking to make higher highs, but it hasn't happened yet. Certainly we came off of that, the panic that happened last week. And, ironically enough, the skew index sort of hit a temporary peak just before the market kind of bottomed on Friday. So maybe this is an indication that some people are taking off their protection that they once put on the put side of things ahead of the Fed meeting here. And maybe now people are looking to go the other way, and maybe some good news here where, what comes out of the Fed come Wednesday.
Yeah, vol got really high at the end of the week. People are pricing in big moves for this week with the earnings and the Fed and the jobs number. So we're not seeing that escalate again like we were seeing it in the last week. What I like to watch for here, I mean, the bad news for bulls in the market, good news for people who are looking to be long volatility is we're getting some higher lows here, a little higher high here. And this hasn't shaken out. What we love to use this index for is when we're trading higher, we get a higher high here, and the VIX itself has not made that higher high. That's a good indicator. Maybe the skew index knows something that the VIX doesn't quite yet, or this is making a lower low and the VIX hasn't done so. So we're kind of in that middle range here. We don't have any clear information here other than we're getting higher levels here. Just something to be cautious of, because the market, again, is just at a very tricky level. Speaking of the VIX futures, very similar spot to where we were last week. We have a very high reading on the cash. The front month future is below the cash, but a very steep second to third month futures curve. Again, people are interested in owning the election volatility. Not a huge surprise there, but it's interesting to see people are expecting volatility to come lower in the short term after this week's events, and then higher in the long term with the election on the horizon.
Yeah, and it's kind of interesting that the front month VIX future continues to trade at a discount to VIX itself. Obviously, maybe that's telling us something that after some of these news events of this week come out, that the VIX settles lower, and people right now are just pricing in, wanting to own some volatility into these events here. We love looking at like the weekly or daily options trading that's going on.
Yeah, exactly, man. We were watching
the straddle.
For the
S&P 500 trade about what's that?
Sorry, you're just a little choppy. I don't know if you know that. You're coming in and out. Yeah, we've been watching that straddle for a while now, and you can just kind of tell the market seemingly last week was underpricing the straddle. The straddle was realizing its move. We were ahead of that curve. Of course, we were having fun trading that. But this week we could tell the straddle just seemed really expensive compared to last week. And it's interesting that so far this week, we're not realizing it today, whereas last week, every day we're realizing that straddle.
Yeah. So hopefully you can hear me a little clearer right now.
Yeah.
Okay, good. So yeah, I think when you look at things here in this picture, I think what's going to play out obviously is Microsoft earnings coming up, and that'll be our big story here. But let's just take a look at the S&P 500. I think where that's at, the trend channel that's been in place. We've highlighted this a bunch of times, Joe. What do you make of where we're at in this upward trend that's been occurring now for a few months?
Yeah. So last week, one of the comments we made was just because the market's weak does not mean it's automatically a buying opportunity. What we want to see is strength following the weakness. We want to see it retaking out some levels. I think it's good that we've somewhat established a little bit of a base here, but we are on a very precarious level. Yes, we're very close to the bottom end of this range, very close to just breaking this range. We did violate it. I don't know if you want to call it a full break. It's just currently above this lower level in this range. So it's in a tricky spot. Now, it might turn into a situation where we had a false breakout and it turns into a very, very, aggressive buying opportunity. That's possible, but it kind of does seem like it just wants to break it and trend a little bit sideways here. So it kind of seems like this longer term trend of this aggressive uptrend that we've seen since last September is stalling out right now.
Yeah, and then I'd have to worry that then we go down into that red channel area, or at least the top end, and test that at 5,100 or so. So, if I'm looking to be a trader here, I'm probably, yes, volatility is a little bit elevated. Option prices are certainly more expensive than they were 2 weeks ago. But having said that, I think I'd probably be a buyer of options to play some sort of move in this market here because we're at such a critical inflection point.
Yeah, I think we've got more news on that front in the trade of the week, to say the least. But this is, for me, again, back to everything we've been talking about, bringing it back together. This is going to boil down to, this trend line is going to boil down to the fundamentals. Are we going to be in a recession on Friday? Is the unemployment rate going to tick above 4.2%? I think it's very clear that this trend line is not likely to hold up if that's the case. We got earnings this week too. Are they gonna show a slowing economy also? So the fundamentals are coming in line with the technicals right at this critical spot. If earnings are great, if the jobs report is better than expected, it's very reasonable to think this is a great buying opportunity. We're gonna go back and test the higher end of this channel. If the reverse is true, then again, we should be very cautious. So this is just a very crucial spot for the economy, for the technicals and the fundamentals. That's why I think optionality is crucial to portfolio protection.
Well, Joe, do you think history holds true, though, that if we do get a 4.2% unemployment rate, that there is a real risk to a recession? Or what's your feeling? Can the Fed cut fast enough to sort of prevent that?
There's so many reasons why like a recession just seems inevitable. We got, the inverted yield curve. We have just so many signs historically that just every time this has happened, a recession has followed. So it does stand to reason. I mean, it would be normal. Like this recession shouldn't be so feared because that's just kind of the normal cycle, which we've seen. The flip side of it is though, what's unusual right now, which is happening currently, is the amount the government is spending is at World War II deficit spending levels. We kind of got into that mode in the middle of COVID, and we haven't stopped. The government's just still spending a ton of money. So in spite of the fact that the Fed is trying to slow the economy down, the government's just continually speeding it up. So there's a chance maybe all that excess spending is going to keep us out of a recession. So we'll have to wait for the data really to have it play out.
Well, I mean, I will say though that, I mean, it does worry me a little bit about a recession though, contrary, because if you look historically, when we've had recession, market's gone down significantly off of all-time highs from that. So it leads to some levels of volatility. I mean, this is why like our strategies, we kind of feel like we're in the sort of the right paradigm to sort of own some of this. Whereas a lot of momentum traders sort of get their head ripped off, so to speak, when we get to these inflection points because momentum traders can't trade it fast enough. I think holding some level of protection while also still participating in, you know, the global economy with equities is probably the way to go.
Yeah, and bottom line is, you might be right. There might be a recession, or this might be a miss, a soft landing, and it might be a great buying opportunity. We don't have the crystal ball. What we do are highly confident of, if you give us the market a long enough horizon, it'll go higher. Over that period, there's going to be extreme bouts of volatility. Are we about to see one? Can't say so for sure. I think chances are higher than normal, but we can't be certain.
Yeah, I mean, I think it would be, speaking of normality, normal for the VIX, for example, to be trading in the 20s if we're going into a recession. So certainly with the VIX sitting here at 16, it's at a discount to where it could go to should there be a recession coming in the back half of this year. So that's something to keep an eye on. And probably why, you know, just a little bit ago on the show here, we talked about the October VIX future trading so high above where the VIX itself is still right now. So you know, that's something that the market is looking at and at least pricing in a probability for. And, you know, what we'd like to see happen is really earnings picture to look a lot better than expected in this coming week between the Mag 7, because I don't think we've hit on this enough, Joe, is the Mag 7 for this S&P 500, it makes up such a bulk of that Mag 7. For the S&P 500 and the broader market to really move higher, yes, we can have new leading participants like the Russell small cap, like some of the banks. But for the market in general to go higher, I really think we need some of these, you know, top names to sort of pull the markets back up and maintain their trend line. I mean, this is a big story, really. Tech earnings this week, you know, the biggest leader, Microsoft, right, is basically representative of the NASDAQ. I think we have some charts on there, Joe. What do you see for Microsoft and their earnings coming up?
Yeah, let's take a look at Microsoft chart again. A lot of the tech charts are absolutely broken. You look at the semiconductors. You know, they're feeling a lot of pain. Microsoft's holding in there. They have not really violated this trend line. If it weren't for the CloudStrike kerfuffle, they'd be a lot better off than where they are now too. So, you know, all things considered, Microsoft has not done so poorly. They're such a crucial component to both the S&P 500 and the NASDAQ. So things are holding in there, and we're right at the lower end of this trend channel. So I think it's a really important inflection point for them heading into this earnings.
Yeah, and I think when we look at some of the technicals here lined up, I mean, Microsoft has been the ultimate leader. You can talk about the Mag 7, but Microsoft, their investment in OpenAI, their ability to build out their cloud computing, the software that they have, everything around it sort of, not, cash rules everything around it, is something maybe people had said in rap in the 90s, but it's Microsoft that has sort of ruled the world. And so that uptrend has been so important. And then you look here at more of, let's drill down in recent days of what Microsoft has done. And that trend has changed to some degree. So we're really trending at the bottom end of a longer term up channel, but in a short term, some of the bullishness is reversed. And I think earnings is going to be very important here. We look at some of the key points as we head into Microsoft's earnings after the close tomorrow, and you look and you see some of the things that analysts are looking for. Joe, what would you like to hear come out of this call?
Apple made huge waves with some of their new AI announcements. Microsoft with, big investment in OpenAI, kind of leading the way with the ChatGPT. They were way ahead of the game. They were cutting into search. They were just, with the speech to recognition model was just the leader. I think I'd like to see them solidify that and kind of build a moat around that area. I know Google has made some really good strides in catching up to them there. So I'd like to see what are some applications with it. Apple's talked a big talk. They haven't really explained exactly what they're going to do with it. They've just kind of hinted on it. Maybe some concrete examples of what they're going to be applications for it would be maybe get some people excited. Short of that, the cloud business with CloudStrike, CrowdStrike, are they going to explain that? Are they going to say, hey, we're moving on from that, we're going to have our own solution, or we're going to ensure that doesn't happen again? Just a one-time write-off.
Yeah, I think that's a really good point to hear if they talk about CrowdStrike in their earnings call, because this is a stock we've owned for clients, and it's done successfully well. We actually took the weightings down on it just a couple of weeks ago, luckily before this whole issue went down with them taking down parts of, well, essentially the internet, I guess you could, so to speak, the servers. It will be interesting to see if Microsoft was okay with that, or if now it was a wake-up call for them to start to develop something themselves. If it's something where they were to say it's okay, I would probably be inclined to almost up an allocation to CrowdStrike at that point, because to me, that's an indication that they're going to be around as a player for a long time when it comes to cybersecurity.
Yeah, well, cybersecurity is not going anywhere. Either CrowdStrike is going to regain their market share, or it's going to go to somewhere else. I love spreading that around to a couple of our favorites cybersecurity areas. I know one of our other favorites is Palo Alto Networks. We've talked about it on the show too. So I love sharing that love. If it doesn't go back to CrowdStrike, it's going to go to one of the others, but it's not going to go lower. People that need that security, we're going to continue to need it, if not more so, in the future. But yeah, I think it's going to be a big earnings. Should be fun to see the market reaction. But with that, with the Fed, with the jobs number, with Apple, with Amazon, there is another opportunity for a trade this week, and we're looking at the Qs, Brian.
Yeah, I mean, look at this trend on the NASDAQ 100. It's kind of actually, normally we set trend channels, like on a straight line here, but for the Qs, it's actually sort of almost increased exponentially, where it's on this curvature upward swing, which has really driven the market in general higher. And so, we're right at the cusp of that exponential rise, and with exponential rises become very fast falls. So the question will be, can we hold this trend line, right, Joe?
Yes, that is a crucial question. And how would you protect your portfolio if you don't think we can?
Well, I'm going to use option trading, right? You mentioned basically Amazon, Apple, Microsoft, the Fed, everything's being thrown at you in this week unemployment number. So I want to use something sort of to protect myself. Actually, even though this week is a big week, I want to look out past the election, look at November options. I think the Qs, the triple Qs, which represent the NASDAQ 100 ETF, is an area where I can add some protection at a little bit cheaper volatility relative to some of the individual names in there. And I'd be looking to buy a put spread. So let's say we break below this trend line here, and I want to protect some of that downside all the way, let's call it protect 50% of my downside, maybe all the way down to 350 on the Qs. If we look at this technicals, that's not something that's totally out of the cards. That's probably the last area of support, a break below 415, or at least test there can happen probably immediately if we break sort of this 450 level. So I'm going to use a put spread. I want to protect against that first move down, that first rush to the exit down. Then I can sort of get back into this market. And I do that I echo that sentiment with the put spread. So I'm looking to buy basically a 50-point put spread on the downside. I would spend about 2.5% of the value of the Qs, which is, somewhat on relatively a high side. But I mean, a 2.5% move, the Qs could be up in a single day. We've seen them down more than 2% in a single day. So if there's sort of this continued upward exponential growth, an up move of 2%, we can make back the premium of the put spread back to the upside by continuing to be long the market with the Mag 7 type names, and be willing to give up maybe some premium just to add some protection on the overall NASDAQ 100.
Yeah, and that's why, this chart is so crucial. There are a lot of investors out there that might think, oh, I rotated. I got out of tech. I went into banks. I went into value. I went into small caps. So I'm clear of this. I don't think there's going to be any hiding out if the tech starts to lead a significant sell-off. Now, it's been a big rotation since the start of July. There's no question about that. Small caps way outperforming tech, but you're not going to see, for me, you're not going to see the S&P 500, like Brian said, make a new all-time high if tech is not going higher too. So tech needs to find some stability. It needs to rebound here if the small caps are going to go higher from this level. The other thing to be worried about is if tech does roll over here, if we start to see this painful drop, which is certainly possible, there's going to be losses across the market. There's going to be no hiding out. And that's going to happen when the economy slows down. So this is why this week is so crucial. There was this adjustment out of the growth, maybe some de-risking, which makes sense if people are worried about a recession. But this recession does happen. It hits all stocks. It's going to go everywhere. So this protection in the Nasdaq seems very prudent, even if you don't, if you're not overweight in the Mag 7. I think stocks will be painful. I think this Nasdaq protection is very prudent.
Yeah, and so that's why I'm looking at November options. What I would do is I'd buy a 460 put. At the same time, I would sell the 410 strike put to sort of lower the cost. Like I said, the cost 11, 12, $13, somewhere in that area is where I would be looking to buy this put spread. So you're basically risking, let's call it 12 to make 38, giving protection. Let's say things got really ugly, let's say, for example, and the Qs went down to 350. I essentially have protected, 40% of that loss to the downside by owning that put spread, because if I'm long the market and had to eat that loss down to there, then the put spread would pick up value likely as the Qs continue to drop. And that's, if it goes through the 410 strike, I'd realize the full value on the put spread. So this is something I can do without creating a taxable event. I can continue to hold my Microsoft, my Apple, my Amazon through earnings here. If things look bright and sort of this is just a bounce off the trend line to go higher, I continue to participate. Yes, I lose money on the put spread I bought, but this is a protection play on the broader general market.
Yeah, and I think it's very prudent. I think it makes a lot of sense based on everything we've been talking about right now this week. A little bit of extra protection. Sleep easier at night. If the market does start to roll over further, we have that protection on.
That's right. So Joe, if we don't have any questions, do we have any today at all?
No, I don't see any. Sorry. No questions anybody. I do see a lot of viewers here as usual. Thank you everybody for tuning in to check us out. It means a lot to us.
Yeah, this is Brian Stutland, portfolio manager at Equity Armor Investments, along with my colleague Joe Teague. We're here every Monday, 1 p.m. Eastern. Please tune in every week as we continue to update previous trades, give you new trades, give some macro opinions about the market, and hopefully make your trading days a little easier.
Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.